Hey everybody, Marty Mazzora here. It's after hours on June 29th, Thursday, 2023. This will be your end of week stock market snapshot. Clients, I'll send it via email to you tomorrow. And then, as usual, either later tomorrow or over the weekend, you'll receive the weekly economic update, which includes the scoring of our PWA index and a handful of the inputs, and anything else that I think is pertinent that I want to share with you. So for this presentation, I'm just once again going to take a peek at the S&P 500 chart, probably keep it to the daily, nothing dynamic, or I should say nothing unusual relative to the patterns that have been developing over the last couple of weeks. We'll look at the QQQ, the ETF that tracks the NASDAQ 100 index. We're going to talk about the graph that you have in front of you again, which is the Bollinger Band indicator and how that's been playing out relative to expectations. And I think I'll just start, though, with what I shared with readers of the blog this morning, and I titled it Second Half Equity Market Setup. And what I did is I referenced our PWA General Conditions Index. In fact, I think I'll just pull it over here so you can see it. Again, many of you, of course, already read this. Essentially what I did is I just compared January 1 of this year to where we sit here at the end of the first half. For example, our PWA General Conditions Index, which is very key to instructing us on the overall macro risk-reward setup. At the beginning of the year, it scored a minus 24.4. The last week's score was a minus 17.7. That's still firmly in the territory that says in the relatively near future, recession odds exceed continued expansion odds. Our financial stress index, which is a grouping of data points that instruct us in terms of tightness in the credit markets. In there, we look at things like the Treasury yield curve, credit default swaps. We look at the high yield spread. We also look at senior loan officer surveys and the percentage of banks that are tightening their lending standards versus easing them and so forth. And a negative 18 means that we have above average stress in the system. That's actually come down notably from some really steep levels here of late. Fear greed barometer, the sentiment index we put together. This is to reflect the potential impact sentiment has on the equity markets in particular. So a positive means positive in terms of what it says about the equity market, and perhaps counterintuitively to some, the more fear we can identify in the market vis-a-vis sentiment indicators, the cost of implied volatility in options, positioning long or short in futures traders on various equity averages and so forth. Higher the fear, the more bullish it is for stocks. The thought process there is that among equity investors, there is a rising degree of liquidity that ultimately can come rushing into the market on an alleviation of the things that they're concerned about. And folks are notably short certain indexes or certain stocks. Well, a short is the sole position that has to ultimately be bought. And when sentiment changes from bearish to bullish, then a lot of buying comes in. Well, it currently scores a minus 75, which, as I say here, is bigly net greed. And just basically take everything I said and flip it on its head, and it ultimately means that the potential for a shift from bullish to bearish can be very impacting it from a correction or a bear market standpoint. Price to earnings ratio, most common used valuation, was 18 at the beginning of the year. It's a high, historically high 21 today. Price to book value went from 3.9 to 4.2 today. Price to sales went from 2.2 to 2.4. Warren Buffett's supposed favorite indicator is total equity market cap compared to the economy, right? It was 158%, which is historically high at the beginning of the year. Folks, it's 173% today. Robert Shiller won a Nobel Prize for a cyclically adjusted price-to-earnings ratio. It was 28.09. It's a very high, historically speaking, 30.55. We have another index that we call our Equity Market Conditions Index. We score it once a month. It's a minus 50 today. We suffice to say that economic conditions still lean recessionary, financial conditions remain tight. Market actors, individuals and pros, were somewhat uncertain at the beginning of the year. They're more certain, more bullish now. Stocks are notably more expensive. And at the end of the day, overall equity market conditions are presently net worse than they were in January. In a nutshell, and I mean this, while anything can happen, again, what are we looking at? We're looking at, the S&P up in the low teens, and NASDAQ up like close to 30% first half of the year. And then a Dow Jones Industrial Average that's up like 1.25%, 1.5%. Equal weight index for the S&P 500 is up 3-point-something%. So the broader market really has done nothing so far this year. And 6 of the 11 major sectors that we track as of last Friday were actually down on the year. Only 5 were up. So this is anything but the setup that you would say is healthy in terms of expectations going forward. We've got other things. Walgreens earnings call, and they saw good sales growth, but several dynamics created margin pressures that they are factoring into their full-year outlook. They've seen changing market trends that have consumers prioritizing value in response to a more uncertain and challenging economic environment. Our customer is feeling the strain of higher inflation and interest rates, lower SNAP benefits and tax refunds, and an uncertain economic outlook, pulling back on discretionary and seasonal spend and responding strongly to promotional activity. In General Mills, another consumer staple, we continue to see labor as the main source of ongoing inflation, showing up in our suppliers' conversion costs at our co-packers' facilities, in our own plants, and downstream in our warehousing and logistics network. Their CEO says it's really important to remember that we still have inflation. I mean, there have been a lot of commentary about disinflation or going negative, but we don't actually see it, and it's driven by labor costs inflating. I mentioned that one because that has real implications with regard to the Fed, and I think speaks to why Chairman Powell has been sounding so hawkish of late. Now, when it comes to inflation, we spent a lot of time here describing base effects. The June inflation print that'll come out first part of July is going to be soft. Year over year could actually be in the low 3%. Wall Street may celebrate that when it comes out. No doubt the Federal Reserve Board, Chairman Powell and company are aware of that, and they're nevertheless talking a very hawkish tune. And it's probably partly because the economy just doesn't seem to want to roll over just yet. Labor market still looks pretty strong. I just read to you from General Mills what they say about inflation. And once we get past July, the base effects are really low on a year-over-year basis, all things being equal. That's going to suddenly make inflation look hotter than it otherwise would, pretty much from July through the end of the year. So if we don't get a notable weaker economy, we actually think there's a good chance we will. But if we don't, then they're really going to have issues with this 2% target that they are so adamant about getting to. I've talked a lot about the structural inflation forces that we think are in play and how a sustainable 2% inflation rate in the years to come we think is virtually impossible. But we'll get into more of that as we get down the road further. So as for the technicals, I'll just, since I rambled quite a bit there, I'll just do these quickly. Looking at the S&P 500 daily chart, let's just zero in first on the price. So we've had this very definite rising wedge pattern here on this up candle on June 15th is when I shot that video, and I said as toppy as it's been since the top. So we were seeing similar patterns, and I threw in our sentiment indicators and so on. Well, we came back and we bounced right off of that. I talked about this the other day. If you run this back last couple of years, that 43.25 is an area that has seen a lot of action as both resistance and support. Made perfect sense that you get a bounce. So we've had somewhat of a 3-day bounce off of that level. that 4,400 could be very stiff resistance. When we take a look at our chosen momentum indicators, we had essentially, which was a bearish divergence. We couldn't eke out a new high on the moving average convergence divergence. This is our sell signal with a breakdown below a rising wedge, very bearish stuff. The most overbought we've been since the all-time peak, and even here. So here we were with similar overbought RSI as we are here currently, or as we were, and we came off of that, came back and basically tested that 70 line, 1, 2, or 3 times before it rolled over. Here we are coming right back. So the fact that the market's turned up for 3 days does not negate the concerning signal that we have here on the S&P daily chart. When we go to the NASDAQ 100, it's even worse in my view. You can see we've broken out, down and then sideways of this rising wedge pattern. A little more of a break here on the MACD, the RSI coming off of that. So we'll see. I still think the time horizon for the next leg down in this bear market, if we're going to get one, is further on in the second half of the year. Some are pushing that out to early 2024. But I think July could be pretty messy. We're beginning to see some technical strength in the dollar. A higher dollar is going to be a real headwind for equities. And maybe it's the second half of July once we get through options expiration on July 19th. Of course, we don't know, but I do think risk is higher now on a shorter term basis. We've seen it, all year on a longer term basis. But along the way, of course, here we were painting very bullish patterns and we were expecting bounces that we got. This is that very toppy, pretty bearish look, technically speaking. And lastly, the Bollinger Bands. We actually track and use the monthly Bollinger Bands on a weekly basis as part of our long-term technical analysis. But I do like to look at the daily as well. So what this is the gray line is the 20-day moving average. The purple line is 2 standard deviations above that. The green line is 2 standard deviations below. So in this context, what I'm looking at is a market that's been hugging that 2 standard deviation line to the top side in virtual parabolic fashion. And that's overbought. You can see we actually peaked above that, and that's not that usual. That's somewhat unusual. So what we do here is we go back the last couple of years, which captures the whole life of the current bear market. And you can see when the market ultimately peaked prior to that in the fall of 2021, we were up here and overbought. And what you'll find is that every single time, at least in the last couple of years, when we come off of hugging that purple line for a while, we break down ultimately below that 20-day moving average, and at a minimum, best case scenario, tag it before we bounce. But in many instances, particularly when we were notably overbought, we hugged that green line on the way down, and we end up with what turn out to be not small corrections. You could see it here. You could see it here right before the peak. Came right back and then ultimately folded, and the bear market began. We got aggressive right in here, hugged that purple line for a while, and when it came off of that, what happened? Danced on the 20-day moving average a bit, and then rolled over and came down, way down, last June. Bounced off of that, then we just hugged it. Kind of looks like where we've been seeing here lately. Came off of it, little bit of resistance here, and then kaboom. And that's the so far bear market low. But here's my point: just when we see it, just really getting over its skis here on the purple line, when it comes off, it tends to be something significant. So here we are with a significant bouncing, and hugging that purple line. Came off of it, bounced right off of that 20-day moving average, and then finally rolled over. Got a little overbought in here, and then here we just really stuck to it all the way up. It's a bit like this, right? We came off of it, bounced right on it, climbing back up, kind of like we are back in here, right? So we'll see. If we don't roll over, that'll pretty much be the first time when we've had a setup like this. So other things that we're seeing about July suggests that should not be surprising if that happens, but I can't say it enough. In markets, anything can happen. Lots of forces out there that could, inspire the market to bounce off of this and ultimately maybe even go into new all-time highs. Right now, technically, We think there's still a bearish enough story to tell, but at some point, if we start capturing higher highs, we've got a ways to go yet. But I'd have to say technically it's now a bullish setup. Not there yet, not our expectation. Certainly open to the idea. Just again, not what our work is suggesting so far. Folks, I'll leave it there. Thank you, as always, for watching and listening. Next up will be our economic report, and it'll be another interesting one, interesting data out this week. And I'll talk to you then. Take care. Bye-bye.